Right. I'm here a little early, so I'm just gonna keep poking through stuff. Sit here. I'm gonna wait until it's actually 5, give everybody time to make their way in, but I'm gonna be here. I'm just looking through some stuff, seeing what catches my eye out here. I hope everybody is doing well, and we'll kick off in like 90 seconds. In the meantime, you have the opportunity to just look at my ugly face, which has got to be kind of fun. It's got to be worth something, I suppose. So what I'm doing now is going through X, and I'm just searching for GameStop GME. And I do this because it helps me get a pulse of what's being talked about. And one of the really cool things about X is that it is a really, really awesome information source because there are a lot of people operating there. So that's what I'm doing right now, poking through X. And then I'm also going to run a couple background queries just against the data set that I maintain to see if anything pops out at me. I use this to kind of supplement what we'll look at on the platform. And then I'm also going to ask Gemini to summarize all recent GameStop news and events. Let that run. And then we will be ready to rock and roll. Poking through GameStop. Let's see. What's this? Oh, where is this from, you guys? Dookie Pie, what up? Good to see you. What website is this that these come from? Clearly, this is some sort of forum, but I haven't seen this. 4chan, thank you. Oh, interesting. I've heard of 4chan. I genuinely don't use it. What is 4chan? Boards. What's the difference between 4chan and Reddit? I'm trying to log on, or I'm just trying to see 4chan. Is this the right site? So it looks like, I mean, it just looks like a forum. Holy shit, that's a lot of posts. 217,000 users. I mean, that's a lot. So this still seems super active. Interesting. When do you guys use this? Or do you guys, most of you guys use... Felix says, sure is, but it can get greasy. Yeah, I can kind of see that, right? Because it already has like this kind of stuff right on the main page, so I could see that. I just want to click into one of these out of sheer curiosity. What's a good one? My instincts would do this, but I think YouTube would probably turn me off immediately. YouTube is, oh, there we go, business and finance. Okay. What the fuck? This is crazy that this is still a thing. Like this is awful. It's like not easy to read. I cannot believe that people still use this thing. Interesting. So this says insider here. The reason why institutions keep loading up on GME despite all the supposed analyst warnings of the stock because they understand what's happening. The company is slowly and quietly becoming a holding company. RC discreetly making moves while keeping the price very steady. Will eventually explode and make many people rich. Goal here isn't MOAS so people can sell and become rich. The goal is to get the share price so high holders don't need to sell. They can borrow against the stock as collateral. I don't think this is an insider, to be honest. Buy as much as you can and just hold it. This is financial advice. I don't believe this is an insider. The reason why I say that is because there's this big thing where I see it on like different YouTube shorts and stuff like that, where regular retail traders, they're introduced to this idea of like borrowing against their stock so that they don't have to sell it, using it as collateral. And it's like, it's not the thing people think it is. People, like, when people say this, they make it seem like you never have to sell your stock because you can borrow against it, and then you just live off of what you borrow against. But anybody that is even loosely familiar with this knows that this is not the case. So this is the kind of thing where it seems like this big unlock for people that are not really in the know. And it's funny because when you learn about this, you then feel like you're in the know, but you're not. So here's the issue. If I am a rich person, my boy's name is Rich because he's rich, and rich person holds a portfolio of stocks, and let's say that this is worth 10 million. What this person is saying, and what the commonly cited poor person understanding is, what they do is, rather than selling, which realize this is a taxable event, instead what they do is they borrow against this collateral because there's value here. So then they borrow the $1 million, whatever it is that they want. And then somehow this cycle continues into perpetuity. You guys see the problem here? It doesn't fucking work like this. If you borrow money, you have to pay this back. You have to pay it back. It's not like this thing where the banks are just like, yo, take this free money and then don't give us anything. Not only do you have to pay it back, it's with fucking interest. And depending on the size of the loan, just like in general, you get better interest rates, the larger the loan being the interest rate, how much you're going to yield. It's just, again, there's a case for this. I'm not saying that this isn't useful, but it's not what the people think it is. It's not what people like this make it out to be. This person is making it out so that if the price is so high, the shareholders don't need to sell. They'll just borrow against the stock as collateral. It doesn't make fucking sense. It's not how this works. There are instances where you might want to come up with some sort of longer term arrangement where you're not pulling your money out because you think that this might grow enough. Because where this can make sense is, let's say that your interest is 5%. And then if you think that this asset is going to grow at 15%, this in and of itself would net you positive 10%, right? This makes sense. Where this doesn't make sense anymore, and what this person is saying, that if the share price goes so high and then eventually it will level off, if this growth stops and you take the loan out against this value, and let's say that this is growing at 3% and you're paying 5%, you're now net negative. Now, you do have to factor in the cost of the taxable event here and stuff like this to see what the overall cost structure is, but all the same, you're net negative, and you still have to pay this. You need to pay this with something. So some people think that this borrowed money becomes the people spending money, but then it's like you have payments. You have to be able to pay the payments on this thing with something. So anyways, that's why I don't think that this is some sort of insider, because this just doesn't make sense. But anyways, I do agree with the broader point that they're making here, that the company is transforming. Now, whether or not GameStop turns into a holding company or something else, I do think that there's a little bit more that we would have to see, because they're going that path, but they've not really gone that full direction yet. And if they were going the direction, here's my argument, and this isn't my argument in terms of I don't think they're going to do it, but this is my steel manning, meaning taking another point of view to try to explore the idea. If the company, GameStop, wanted to become a holding company, why wouldn't they do it faster? Like, that's the part that I don't understand, because they're in the process of divesting the unprofitable parts of the business. Makes a ton of sense. They're in the process of closing their unprofitable stores. Makes a ton of sense. But if you knew that this is the direction you wanted to go to become a holding company, why would it be at such a slow rate where we're doing these store closures over the course of years? That doesn't make sense to me. So that's not to say that it couldn't happen, but if the company wanted to be a holding company, they already have the capital to do so. So I don't see why it would roll out so slow, which is why I actually think they could have an element that might become a holding company, or, you know, the broader org could become a holding company, whatever that is. But I do think they're trying to salvage the brick and mortar business. Why else do you get into physical card grading that needs a physical location, right? Like, it just doesn't make a ton of sense to me. So I could see it potentially happening, but I'm not so sure that it goes this way. Banks are out here holding bags. Okay. Walked into GameStop. When I realized the 7 billion cat errors in GameStop convertible note completion same day. That's actually really interesting. What is this? Take a step back and see the way I see things. No price rainbow moving averages. On balance volume and RSI. I can only imagine how many charts you guys have looked at of people doing weird fucking LSD shit like this. I'm so bullish, I'm shaking. That's awesome. I love that. This says, you bullish on GameStop. I'm not here to cheerlead or bet against any stock, but let's break down GameStop. Cash pile and Bitcoin bet. Recent fundraising. Okay. Meme stock momentum. Okay. Strategic pivots. This is the big one. Like, this, I think, is the big one. Hands down, is the strategic pivots. What do you guys think? Like, if you were to think about what, like, being bullish on GameStop, I imagine most people are to a degree if you're here, right? But, like, what do you think that, like, the true bull case is? Is it the fact that they're investing in Bitcoin? Is it the fact that they're pivoting the business? Like, what do you guys think? It's me, says, in my honest opinion, GameStop will be Back to the Future arcade locations upgraded for current times. That's an interesting idea. That's a really interesting idea. Huh. Curious idea. But I still think there clearly is an upside case here. And when I think about it, it's a mix of things. That's why I'm curious what you guys think. Lauren says, I think they're pivoting, but I have no idea where. I agree with that. And I think the way that you frame it is also correct, right? And the fact that we can see signs that the pivot is happening. We can see those signs. There's some big changes. The investment into Bitcoin is a change. The card grading part of the business is a change. And if I'm not mistaken, I think that there's a more recent piece of news I have to catch up on GameStop that moves us further down this path. But let's take a look at what Gemini says. I'm going to do this. I'm going to ask Grok the same thing. And let's see what they say. So this is what Gemini says. This is what Grok has for us. Gemini says, remained in headlines, significant restructuring, foray into crypto, which is correct. Continued volatility, correct. Actively raising capital and signaling a strategic shift in its treasury management, correct. Yeah. Central theme, aggressive capital raising efforts, definitely. So I'm going to ask Gemini what it thinks of the capital raising. What do you make of the capital raising efforts? I'm actually very curious how it would analyze that. It talks about the offering, purchase of Bitcoin. Yeah, so this is all just standard stuff. Let's see what it says to that. And then let's see what Grok says. Grok says the note offering, obviously Bitcoin, yes, strong earnings. It did have a really good earnings for sure. And again, when we reviewed earnings, this was the main issue is revenue, because revenue is still falling. But that will happen as the company is going through shifts. So I think you have to expect that. Calm down, Jack says, I wonder if it'll hit 19 by August. If what will hit 19, the price of GameStop? I would take the over on that. And as you guys know, it's not because I'm some sort of like GameStop permabull. I really do my best to just objectively evaluate what I'm looking at. But the reason why I would take the over on that is because if you take a look at the 19 handle, it really hasn't been in the 19 handle until August of last year. And I think it's objectively true that the company is more valuable today than they were in August of last year. And I think you can see that also generated through their earnings, right? Like they came through at 17 cents on their earnings where they were expected at 8. They doubled. So yeah, I don't really wonder if they'll hit 19 unless there's something there that you guys are seeing why 19 might be a number of interest, but I just don't see that. Also, as always, it's hot. The shirt's coming off. That's just kind of, we're in this time of year. If you're new to the channel, I'm one of those dudes. I live in Southern California, but I don't like running the air too much. So it's easier to take a shirt off. But yeah, I don't think 19 looks super probable to me. Stack says, as crypto saturates our lives, physical stores can sell crypto wallets. Yeah, and I think there will still be a use case, realistically, for physical stores. Like, I don't think, and I think, in my opinion, that's why GameStop isn't unwinding all of the stores super fast. Because if they wanted to, they absolutely could. But I don't think so. And I think that they like purposefully want to keep the stores, and they're just doing it in a highly selective way, which again, to me, it's like that makes complete sense. Why would they not do that? Especially if they view some sort of future element of their business that has a physical footprint for sure. So Daniel says, I'm married and my wife is premenopausal. So the air is cranked. That's rad. Yeah, I'm weird, man, because it's like we run the air, especially at night when we're trying to sleep, because, you know, it's just kind of a much better sleeping environment. But I don't know what it is about running the air. I feel like it's one of those things where if you are just a dude, there has to be some sort of change in your life that leads to, at some point, turning a corner and being like, I don't want to run the air anymore. I don't know why. It's like the thermostat thing, right? That whole thermostat joke is a reason for it's there. It's a good joke for a reason, I think. Stack says they can also serve as physical location for currency exchange, kiosks for crypto, transition to cryptocurrency bank. That's really interesting. I'm not so sure that they would want to go into banking, though. That's a big pivot. That's a really big pivot. I'm not sure I would see that. Let's see. So the trading cards, we already talked about that. This was it, the collectibles. So integrating collectibles into 3,200 stores with initiatives like Power Packs and partnerships with PSA. The move aims to offset declines. Let's see what this is. This is what I was thinking of. Oh, God. We need to get these people to run with TLDRs. Something about burning money. I don't know. I tried to read this twice and I got bored, so I'm just switching to this. Young Bill Lees of today sticking. What the fuck is this article, man? Here we go. The trading card market, whether it's sports, Pokemon collectibles, is aligned with our heritage. It fits our trade and model. It appeals to our core customer base, which is deeply embedded physical retail. I completely agree. And then, like, this is him signaling, right? Physical retail. That's a very, very specific point that he's highlighting. Unlike software, it's tactile. Unlike hardware, it's high margin potential. It's a logical expansion. Yeah, like I love that. So it's a great way for him to frame it. Hard to say greater emphasis collectibles will look like for GameStop. Cohen didn't take questions at the annual meeting. The company hasn't held public calls in 18 months, according to data from S&P since last fall. Partner, yeah, so we know all this stuff. Which this, I think, is something that you have to pay close attention to, right? Because as we're trying to piece together what direction this might go, how and with what severity, the fact that they're emphasizing physical retail, I think, is really pertinent here. All right, so let's take a look at where the stock sits today, what the latest is. First, let me finish this real quick, see if anything pops out at me here. Colin says, thoughts on leaps with this low IV? That's a really common mistake, actually. And I'll show you why. So, Colin, are you in the Discord by chance? Because if so, I was going to tell you to hop in the voice chat real quick, and then I can actually like talk to you, and I could discuss it with you. If not, the chat's fine too. But the first question I would have for you, Colin, is talk to me about the low IV environment. What do you mean by that? Are you using implied volatility percentile as your benchmark? Are you using implied volatility rank? Are you using raw IV? I want to be clear, by all those metrics, you're completely correct, by the way. But there's a really common mistake people make here, and that's what I want to show you. Colin says not yet. That's totally cool. No problem. So here's a quick lesson on options because it's really important. So when we look at IV here for stock, right? So the current IV 68.74%. Yeah, okay. So Colin says 52-week low. So he's using IV percentile, which is great. IVP, implied volatility percentile, is right now at 2%, which is exactly what he's saying, that this is really low. For anybody in the chat that's more familiar with options, why would I say that the concept of leaps here being used when IV is low it's not necessarily wrong, but it's just the incorrect attachment. I wouldn't connect those two too heavily. Like I still would acknowledge them for sure, but I wouldn't connect those two too heavily. Why is that? Any more option savvy folks in the chat have an idea why that might be? We're talking about low IV environment, and then we're talking about capitalizing on this with leaps. No guess? Let's walk you onto target. As always, when I do stuff like this, I mean, this is my standard preference. I prefer not to give people direct answers because I don't think people learn as much that way. Even though it's a little slower to do it this way, I think it connects way more synapses in the brain to help these concepts stick in. Daniel says, wouldn't you have to sell current position at low IV? Not necessarily. It's a good guess. But what does this measure? Talk to me about what does IV measure? Let's look at IV. IV, implied volatility. What does this measure? This measures a specific time frame. So this is a forward expectation of volatility. But not all volatility. 30-day vol. So what you're about to learn is what a volatility surface is. And you'll see why. So leaps, Daniel is exactly correct. Good job, Daniel. Daniel says how much the market is pricing in the forward expected moves for the next 30 days. That's exactly correct. Good job. So when we look at leaps, what are leaps? Leaps are long-term equity anticipation security. This is another common thing that people fuck up. It's not LEAPS, the whole thing. It's LEAPS, leaps. The entire thing is an acronym. So like you can buy one leaps, which sounds weird. So most of us don't do that. We would still say I bought one leap. Just weird to say it leaps. But anyways. So what's the issue here? No one says, so then it would be more efficient to use shorted dated calls and roll them. Great guess. So a couple things. The first thing is if we're actually trying to isolate volatility, that's a whole other conversation that we can talk about briefly. The more important point here is I want to get us back to why the original point that, who was it that said it? Sorry, I forgot. Where's it at? Where the fuck is the leaps thing? I think it was Colin somewhere. Maybe, I don't know. Anyways, so, oh, there we go. Colin says, thoughts on leaps with this low IV. Sorry about that. So here's the issue. Leaps deal with greater than 1 year expiry. Long dated options. IV, as measured here, is a 30-day measure. What do you notice as I frame it this way? What's the problem with this in a nutshell? What do you guys see? Help me out. I'm phoning a friend. I'm phoning 37 friends to be specific. Shout out to you guys. 38 friends. Colin says specifically Jan 2027. Lauren says 30 days does not equal a year. Bam. Here's the problem. Colin, what you're doing here, exactly. ZX Borg, spot on. Exactly correct. So what you're doing is applying, Colin, a sound fundamental approach, but you're just missing some of the nuance. So the vol for leaps is completely different than the 30-day vol. It's completely different. The way that the vol in leaps is behaving is completely different than the way that the vol for 30 days, what we would call the underlying vol, is a different ball game. So what this means is we wouldn't want to inherently use implied volatility percentile, which is looking at a 30-day metric, to make an assumption about the vol for leaps. So here's what this means. We can make a guess. We might make a guess that if near-term vol, 30-day vol, is very low, we might guess that longer-term vol is also low. But it's not inherently low because 30-day is low. And there's no reason not to get more precise. So that's the first part of that whole concept. And let me show you. If I take a look at these different expiration cycles, what do you notice about the volatility as you go further out in time? Aquí. Front vol, let's just call everything in here like a weighted average, like 30-day vol, is somewhere in the mid 60s. Let's call it 64%. Yet, if we go further out, your average is really like 77%. So there's a 13-point variance. I'm sorry, a 9-point variance. 13-point variance. I don't know what the fuck just happened to me there. Might have just had a stroke. My bad. 13 points between these. So then the question becomes, is this 77% actually low? Because we can't use implied volatility percentile. It's a different vol. So there's a few ways to do this. You can either use historic pricing and come up with your own metric. I think, if I'm not mistaken, actually, let's see really quick. I don't know if this has long-term vol. Let's see. Oh, it does. This is great. So what we can do is take, so this is literally beautiful. So let's go back to the 20th of June. And let's take a look at the difference between this. Notice how low 30-day vol is here compared to, again, leaps, which is out here all the way at the other end of this graph, right? So notice the difference between these, huge. So now let's go back and let's go back to the 20th of June, just out of curiosity. That got completely blown out because of the 0 DTE. I don't know if there's a way to turn that off. I'm trying to make this easier to see. There we go. This is fine. So this is, let's go back like a month. What is it? 28 June. We'll go back a couple months. This is perfect. So if we go back to 28 June, what do you notice? If we go back to 28 June, long-term vol, about the same. So then if we go back further, again, this is 28 April. I think that's as far back as it lets us go. So let's go to 28 May and see what long-term vol looks like. But notice the difference in front vol, how much front vol moved. Now let's take a look at how much back-end vol moves, the difference between May and now. What do you notice? All of this movement that you see in vol is happening in the front. So again, using even this expiration, that's 233 days to expiration, from 28 May, vol was 74%. I'm trying to see if I can click the other line here. Let me get rid of these. Oh, cool. So for the current expiration, vol there is 75%. If we add the other, it's still 75%. So what I'm showing you here is that there is essentially no change happening with long-term vol. So if you bought leaps with an expectation that you would make money as vol increased, what you would end up seeing is the vol in GameStop here. Let's say if vol goes up from 68 to 100, you'd be saying, damn, that's a big move in vol. I should be up a bunch of money. And then when you take a look at your leaps, you're going to be like, fuck, I didn't see any of it. What happened? This is what happened. You're playing a completely different duration vol than what you're looking at in the other example. Let me know if you have any questions on that. Lauren says, in the front, do you mean short term? Yeah. So whenever we refer to front and back, it's just talking about terms or expirations relative to one another. The front is some sort of front term near. The back is further out in time. Shahazad says, yesterday's stream is showing private, unable to access it, wanted to catch the rest. I'd have to look. I don't know why. It might have gotten taken down for some reason. Sometimes YouTube does that, especially with the streams. I don't honestly remember what we looked at, if there was anything that we looked at that led to them not liking it. But yeah, yesterday was kind of a random stream anyway. So, but yeah, back to this. So specifically for Colin, does what I just explained make sense? Because your instinct in your idea is it's good. You have a good idea. The issue is if you executed that idea as you had designed, you probably would be like, what the fuck happened? Because it wouldn't be, in at least based on what I could see here, it really wouldn't be what you were looking for. Because if you did get that move in vol, you wouldn't really have much to show for it. Okay, cool. Glad that that makes sense. I like to, well, at least I do my best to try to make it connect all the way. So beautiful. Glad that that's all good. Now, let's talk a little bit about, I think Lauren had a follow-on question that I want to make sure we can get to. Where was it? Oh, no, we already got it. It was just about the front. Okay, cool. Yeah, we Gucci then. Sweet. So now let's talk a little bit about one other factor with respect to like more volatile names like GameStop with respect to how volatility behaves. Because in that trade idea that you had, that you shared with us, you wouldn't actually be isolating volatility very well. And it's because if you're using leaps of some sort, so let's say that you were trying to, let's say that you were trying to gain exposure to a longer term idea, or you're using leap calls, whatever the case is, you're using some sort of longer term option. Now, the issue that you're going to face with that is almost all of the volatility in GameStop is going to occur in the front. And the other thing is, if you do start to get, if you do start to get those moves, your long-term option, specifically a long call, is really going to be based on direction. It's kind of it. It's just going to be a directional play because you'll still have the delta of the position. Delta doesn't go away. Delta is delta. We learned this actually on the stream yesterday, that regardless of how far out in time you go, delta itself is delta. So what that means is if you get a 50 delta that expires in a day, or a 50 delta that expires in 500 days, it's still a 50 delta. Now, the movement of delta itself will be different based on gamma, but delta itself is delta, no matter what. GP says, so you don't benefit too much from low 30-day IV if you buy 90 days more out. That's exactly correct. So what this is saying, and it's not inherently 90 days, 60 days, 100 days. It depends on how that longer term vol is. So in this context, if we take a look at 90 days, we can see 90 days is actually moving more, right? So if I were to just ballpark this, I don't know why it doesn't let me use all points on the line. I think it's just because of the expirations. Yeah, it's mixed up on the expirations. But you can see that at 60 days, there's still a big variance. So this is 51 days, which is 90% IV. And then down here, it's 61. So you can assume at the 60, it would have been like 60 something. So there's still a pretty big gap here. So in the 60-day time frame, there's still a move in the different terms. And then in the 90-day time frame, there's still a move. It's just less. And then as you go further and further out in time, the movements shrink down into effectively what you see here, which is pretty much flat, which is, again, this is one of the important nuances when you're doing stuff like trying to trade vol. Oh, I'm an idiot. They literally have a tool up here. This is awesome. That shows us vol for different terms. Let's take a look at, yeah, so like 30-day, you can see this is taking us back to 30 December. So it's given us about 6 months. And you can see compared to like the time frame here, front vol is super low, right? Because this is where it's at relative. Let's take a look at 90-day vol. Its 90-day vol is also quite low. But if you take a look at the variance here, it's a completely different scale. Because the variance here is from 113 down to 55. And if you go to 90 days, this is 113 down to 70. So a 15-point gap between 30-day and 90-day front vol. And then if we go to 365, you'll notice that it's actually kind of right in the middle of the range. So this is at 76, whereas 6 months ago is at 93. So actually quite tight. And funny enough, the vol in those leaps, based on the original concept we were talking about with Colin, this actually looks like the vol might go lower. So that would be the ultimate irony with this kind of idea, is that placing this trade based on 30-day vol definitely looks like it might revert up, but this looks like it might go down. So that I'm chuckling about that because options can be so fucking tricky, where the idea that Colin had was good. Like it's a good idea, but it's a really good expression of how, without a pretty good understanding of options, how even a good idea can lead to losing money. It's that nuanced. Gary says, got a couple leaps only because I'm expecting price to go up to 60. Yeah, and that's a completely different thing. Is the funny thing is, depending on when the leaps were bought, they might have been bought very expensive relative to what it was recently. But if you take a look, this is another thing when we talk about something like Vega. Vega is an option sensitivity to changes in vol. So even though the gross changes here aren't as much, these options are way more sensitive to these changes. It's like a scale. Does that make sense, what I just said? If not, let me know. What I'm talking about there is Vega. So when you go further out in time, these will have higher Vega, greater Vega, which is premium change per 1% change in vol. So the Vega is going to be greater for longer term options. Vega here is lower. So when you see a larger Vega range here, and this might have a smaller Vega range, Vega can still impact the premium of this option more. And it's because the Vega on these longer term options is so much higher. So let's look at an example together. If we look at the Vega for 15 Jan 27, I'm just going to look at the calls. Vega here is 0.105 for 566 days expiration for these leaps. 1.105. And then if we take a look at 20 days for the at the money, Vega is 0.022. So Vega is about 5 times higher for these. So what that tells you is that even though the total range is smaller in terms of changes in vol, it will have bigger impacts when they do happen out here, right? So to make that example complete, actually I'll use the Google Sheet real quick. I think it'll be easier. We'll find a spot right here. So we just said this is for the at the money. We have 2 different Vegas. So let's say let's say that we have 2 expirations, 2 different terms. We will have the 20-day and then 566-day. And then let's say that we have IV, an input change in IV, Vega, and then we'll have premium change. And this is the assumption that we're going to use a similar delta. So I'm going to move this off to the side really fast so we can solve for this. So let's do like a 50 delta. The 49 delta is the 40s way out here. And the Vega for these is 0.117. This is the 560 days. So 0.117. And then the vol for, I'm just going to use the expiration, is 79.84%. 79.84%. Cool. And then for 20 days, going to that 50 delta, or the closest to 50 delta that we can find, which are these, the 24s, our Vega is 0.022. 0.022. IV for the expiration itself, 66.13. So now what we can do is we can simulate different changes in vol to figure out how these two relate to one another. So let's say that we get a 10-point change in front vol and a 2-point change in back vol. So if we want to calculate what the change in premium is here, we would simply take the total change that we're getting, multiply that by our Vega, multiply that by 100. This is for a 1 lot. So you're getting $22 of Vega here. And then if we replicate that here, you're getting $23.40. So what do you notice here? You notice that even though the IV change, the actual change in 566-day vol is so much lower, the 5th, yet it has a greater resulting Vega impact, and that's because it has a higher sensitivity to volatility. A little bit heavy, so I'm going to take a pause there. What questions do you have? This is obviously more so for the options folks out there. What questions do you guys have? Does that make sense? If I explained that well, I would honestly be shocked. I try to explain it well. Well, I always try to explain it well. But this shit's a little tricky, so I feel for you guys. Okay, so it looks like I'm not seeing anything, so you guys are good. So to summarize all of that, what I'm showing you is that there is a different volatility for different terms, okay? And we know that Vega increases the further out in time you go. So the sensitivity to changes further out in time is greater. So that means even as the terms, the vol changes differently between them, and on the tail end, it doesn't change that much typically. That means even on a small change, you can absolutely find that you get a bigger change in your premium as a result of Vega than a much larger move in the front. So Vega and really term structure, this is what term structure is. It's really, really, really important to understand term structure and options trading. I'm actually probably going to clip this section to make a standalone video on it, because I think that especially using something like GameStop is such a great example for this. And it'll be a good reference, I think, for people. Lauren says, wait. I'm waiting. Vega isn't always higher further out, right? It generally is. It's not always, but it generally is. The reason why I say not always is because it depends on what we are normalizing off of. So here's what I mean by that. If we pick a strike, so let's say that we're going to pick the 20, let's say that we're going to pick the 40 strike. For these front options, the Vega is 0.006. We go all the way out here to the 40s. The Vega here is 0.117. Okay, fine. So for stuff that's round about the money, this is generally speaking what you're going to find. The only instance where you might find some nuance to this is if you have an option that has very little extrinsic value. So that can skew things if there is some sort of expected event, but those get into like very rare environments. In general, if you normalize off of delta or if you normalize off of strike, you're going to find a higher Vega the further out you go, essentially always. But there are nuances. GP says, why are far dated calls more sensitive to changes in vol? It's a great question. Really great question. So let's reason our way there. If we break down, I'm so stoked, by the way, on this session, because this is like really useful option stuff, I think. So I'm really, really glad that we're talking about this. So if we think of vol, we have the premium of an option. Premium is broken down into two buckets: intrinsic, extrinsic. Intrinsic is simply how far in the money. Extrinsic is time and vol. So we know that volatility plays inside time, and we can reason through this. If I were to try and guess what the weather is going to be tomorrow versus what the weather is going to be a year from now, which one of those guesses is probably going to be more accurate, naturally speaking? Likely the guess for tomorrow, right? I can base it off of what's happening today. I can reason my way, and it'll probably be closer than what I'm guessing further out in time. So what I'm showing you is that as time expands, as we're trying to forecast moves over longer durations, we expect greater variance. Okay. Now, if we think about where this variance impacts in terms of an option, it impacts the option in the extrinsic value. So if an option has more time, it is a larger portion of its value that can be impacted by this expected variance. So this is why you see options that are further out in time have higher Vega and more sensitivity to their term implied volatility. And I'm emphasizing that comment of term volatility. It's not the IV that most of us, when we say IV, most of us were talking about the underlying IV, which is 30 days. ZX Borg says intuitively, seems like leaps, there's more time for volatility to affect actual price. Calling it Vega is just a way of measuring the effect. More time for volatility to affect. Yeah, I think that that's a really good intuitive way to think of it, ZX Borg. I like that. Yeah. GP says, my understanding is leaps are still a good buy at low 30 IV because of Vega. This is incorrect for literally what we just discussed. The reason why the way you're framing that is incorrect is because, again, to give you this example, if we take a look at how much 30-day vol has changed compared to 365-day vol, right? Which is the furthest out this has. If I go back and I take a look at the total change in the last 2 days, vol, 30-day vol, went from 76, essentially 76.10 to 76. And then further out in time went from 56 to 55.2. So a bigger change here, day over day. Yet if we go further back and we take a look at the change here, 30-day vol goes from 74, 365 goes from 81, 81 to 76, 74 to 55. So basing a long duration option trade based on 30-day vol doesn't make sense. Because what 30-day vol does, like this is actually an even better example, because take a look at this. 30-day vol, if I plot, can I do horizontal lines here? If I plot a horizontal line here, or about what I can get for a horizontal line, that's 30-day vol. If I plot a horizontal line here, that's 365-day vol. So if I get rid of this spot is about literally the middle of this range. So if we were to IVP this, we would call it about 50%, maybe a little bit lower, maybe 40%. But if we do this comparatively for 30-day vol, 30-day vol right now is literally at 2%. And the reason why it's at 2% is because it's literally at the very bottom of, in this case, this is looking at 6 months. Most of the time when we're using stuff like implied volatility percentile and stuff like that, we're using a longer term time frame. We're typically using 1 year. So GP, let me know if you have any follow-ons based on that. So the summation for that is leaps are not a good or are not a bad buy based on 30-day vol. Leaps are completely indifferent to, not completely, but generally indifferent, kind of completely actually, to 30-day vol. Because again, this is a perfect example. If you take a look at where these two are in their relative ranges, 365-day vol is about halfway. Again, maybe 40% to 50%. 30-day vol is at the very bottom. That's very different. Very, very different in terms of volatility behavior. Now, based on that little calculator we just made, we can see what the total premium change would be out of curiosity. GP says 30 IV percentile. Same. If you use 30 IV or 30 IV percentile, it's the same mistake. Again, literally it's the same exact thing. It's just the way to think about implied volatility percentile is that this is implied volatility percentile. This white line, that's effectively what implied volatility percentile is. All we're doing is plotting what the current vol is relative to the past year. That's all. So being 30 implied volatility percentile or 30 IV raw, it's the same inaccuracy. And the reason why it's an inaccuracy is, again, because if we take a look at how long-term vol has behaved, it's gone a completely different direction than 30-day vol, right? Take a look at this period here. Long-term vol in this move, it jacked from 65.8 to 81.4. If I take a look at 30-day vol instead for that same effective move, it went from 83 down to 58. They literally went different directions. So if you're basing a long-term option based on 30-day vol, you're literally basing it on the wrong thing. ZX Borg says, if you buy deep, hey, yo, thank you, Brandon, for the $1.99. That will go to my DoorDash driver tonight. Really appreciate that. ZX Borg says, if you buy deep in the money leaps, calls as a stock replacement. Vol/extrinsic is only a small part of the cost, so not as important. This discussion seems more relevant if you're buying out of the money, right? Great instinct. So it's probably more relevant than you might think, though, unfortunately, and I'll show you why. Because if we take a look, let's grab our handy dandy calculator and let's just literally create a plot for intrinsic and extrinsic. We can break it down very simply. And it's funny because I literally was expecting the stream tonight to be pretty quick, but this is such an awesome topic. I'm stoked. So let's take a quick look at the premium here. So if we take a look at 18 July, and again, we're doing that same, we were doing a 50 delta. The premium for the 50 delta is 107. Oh no, let's do an in the money though. Let's do an in the money. Let's do a delta of 81. So an 81 delta here, and we'll update the rest of this stuff, is 250. I'm going to call it 250. The Vega on this option is 0.015. The implied volatility for the expiration is 66. We'll get rid of the IV changes. And then now let's take a look at the 566. We'll do the same 80 delta, which is this one right here. So that puts us at 1130. Our Vega is 0.083. And the expiration vol is, I'm just going to call it 80. Okay. So what we can do is we can literally calculate intrinsic and extrinsic values. So 23.59 is current spot price. So technically I need the strikes for these. So the 566 strike, that puts us at the 18s. And then the 20-day puts us at the 21.5. Cool. So our intrinsic value is literally just how far in the money we are. So we take this minus this. I'm going to lock this one so I can drag it. So this is $2 in the money. Oops. This is $5.59 in the money. And then we can figure out our extrinsic value, which is our premium less intrinsic, which is 41 cents here. And then our extrinsic value here is 571. So based on what we've just used, based on what we just discussed, going back to ZX Borg, do we think that a change in vol will have a larger impact out here at 566 days to expiration? Or do we think the larger impact would happen here at 20 day? Well, let's see. If we take a look at, oh, I forgot it's on this one. If we take a look at their change in vol over a set period. So let's do from this move. So this is 91.3 vol. And then as of the latest, this turned into 55.2 vol. Okay. And then for the long duration, again, this isn't accurate because this is using 365 versus 500 days plus, but we'll do it anyways. So this is 81. And then this is 76.1. So in this specific move, the premium change is greater for the 20 days. Well, in this case, it's 30 days compared to the 566 days. So the difference in the premium change here is 54 versus 40. And that's because the vol for the front changed by 36.1. The vol for the back changed by 5. So the scenario where this can be different is if vol in this case changed instead from 81 to 76 and it went to 73. Well, all of a sudden we see if vol there changed by 8 points, the longer term option absolutely would have moved more, even though it's at an 80 delta and it's really far in the money. If this is at 75, it's close to being the same. If this is 74.5, I mean, it's about the exact same. So essentially, if 20-day vol moves by 36 points and deep vol moves by 6.5 points, it's the same Vega impact. So ZX Borg, the answer to yours is it does depend on the move on back-end vol, but you can absolutely have a move on back-end vol that will overwhelm the front move. And it's because of that heightened sensitivity, even for a deep in the money option. Because when you're really far out in time, deep in the money options still have a lot of extrinsic value, right? So even if we go to a 99 delta, these will still have extrinsic value. And this is obviously super high delta, right? So if we look at this option here, which is a 93 delta, it'll have at least like 10 points, or it's 10 points in the money. Well, let's just do it really fast. So this one, we're looking at a strike price of 10. And the premium on that is 15.5. So this, yeah, this still has $10, $20, $20 of vol. So I'm sorry, of extrinsic value, which can be played with by vol. And that's using, again, a greater than 90 delta option. So if you go further out in time, even deep in the money options will have a lot of extrinsic value relative to something that's in the front. GP says, I've been using Market Chameleon for IV percentile for estimating whether option premium is a good price. Is Unusual Whale's interpolated IV a better tool for that? So. Yeah, I wouldn't say it's necessarily a better tool if you're using implied volatility percentile. It's just, you have to use the right tool, right? So if you're using something that's like a really long dated option, then it doesn't matter if you use implied volatility percentile from Unusual Whales or if you use implied volatility percentile from Market Chameleon. It's just using the wrong tool. So I don't know what other tools Market Chameleon has. If Market Chameleon has a tool like this that shows you some expectation of volatility or implied volatility percentile for these different durations, then it's essentially the same thing. The way to think about it is that no matter what like software you want to use there, doesn't really matter as much as like you just using the correct tool. So let me know if that answers your question, GP. If Chameleon has something that allows you to plot implied volatility or implied volatility percentile for different durations, then it's the same. But in this context, it doesn't matter if you used Unusual Whales, or which I do have an affiliate link for, being completely transparent. I'm obviously not pushing them here. It's just a tool that I use. But yeah, I just don't know what Market Chameleon has. ZX says, I also noticed you talk a lot about trading certain deltas rather than a strike. Is thinking of strikes immaterial and I should be thinking of deltas when I look at a strategy? 100%. Strikes do not matter essentially at all. Strikes don't matter in the least. A really common new trader mistake is they'll do something like this. And let me know if this is something you've done, because it's something that I've done. Is I would say to myself, I think GameStop is going to 25. So let me go grab a 111 dates expiration. I'm going to grab a 25 strike option because I think it's going to go to 125. And it's the complete wrong way to do it. That what price you think it might go to does not matter relative to what strike you pick. Doesn't matter. The way to think about a strike is it's like just a name. That's kind of it. It doesn't matter at all. It gives you a value for intrinsic, extrinsic value, so it matters in that capacity. But what ultimately matters is the Greeks for the option. And that's because that's how you determine how the underlying itself is going to, or how the position itself is going to behave. I still don't fully understand that with Delta. I mostly do, but not 100%. Talk to me, Lauren. Also, Lauren, well, you're not in the Discord anymore. I was going to say you should pop in the chat so that you can explain yourself better, but I don't think you're in there. So what do you mean? When you say you don't understand that with Delta, you mean the process of like using Delta? I wouldn't just use Delta, by the way. There's no reason to just use Delta. It's just Delta is kind of like a normalizer. Once you understand options, you kind of have a sense of what the rest of the Greeks will look like based on what the Delta is. So for example, I know that if I'm looking at this and somebody says, I bought a 50 Delta option that's 202 days out, and I'm curious if I should have gotten the 20-day. There's a bunch of things I know out of the gate. The first thing I know is that theta is higher here. I know that gamma is higher here. I know that Vega is higher here for that option, for that 50 Delta option. And it's because I know where 50 Delta is in relation to the rest of the options chain. And then I know how the rest of the Greeks behave around that point. Same thing is if somebody says I'm trading a 111-day option and I'm comparing between a 50 delta and a 20 delta. There's a bunch of things we know about the 50 delta compared to the 20 delta out in 111 days that we can extrapolate across the other Greeks. So the way to think about really trading options at all is the Greeks allow you to build the position that reflects your idea. It was funny. I was on a coaching call earlier today about literally about this exact thing, because in this context, somebody was looking to trade another stock, except they're looking to trade a higher velocity near-term move. That's actually what this calculator was for, this one. So this was looking at the spot price of something, and we're expecting a 20% move with an expected holding duration of 20 bucks. So what I was doing is calculating what the P&L would be at the expected move, and then saying what's the relevant holding cost between these and which one makes more sense based on that, right? So in this case, we can see this scenario here for whatever reason. The holding cost in terms of theta is higher for this near dated option. However, because of what you get from delta and gamma, specifically gamma, which provides convexity, if you get the move that you're looking for, you make way more money with this. So even though it has a higher holding cost, it nets out way better than this. So this is the process of using the Greeks to fine tune the idea, because in this context, rather than going to 202 days to expiration based on their idea, really what they should have done is gone to 83 days to expiration. And it's because it represents their idea much better, and it would make a lot more money based on their idea. Lauren says, why would you pick a 20 delta over a 50 delta when buying a call? That's the part I don't understand. Great question. So let's take a look at a scenario. Let's do a 48 day. Let's do a 50 delta. And then let's grab a 20 delta. Now, before I actually show what the impact is here, somebody in the chat that's familiar with options, what can you tell me? What are we about to see if we take a look at these two things compared to one another? I don't want to plug it in yet. I want somebody to be able to explain it to me before we look at it. Okay, Lauren has the first point. So the higher delta is going to be more expensive. Good. What else? In this case, a 50 delta is going to have a higher gamma. So let's take a look at the scenario and let's see what we see. If we take a look at the P&L, this is the 50 delta option right here. And let's say GameStop goes up 15%. This option makes 202 bucks. If we take a look at this other one, your option only makes $100. That seems kind of shitty, doesn't it? It's like, why would this make half the amount of money? Well, it's because if you take a look at the cost here is 71. This is 171. So what that means is I can literally buy two for the cost of one of these. So if I choose to do that, then I'm gaining convexity. So if we take a look at what delta is here, if we take a look at delta starts to gain this steepness. This steepness is gamma. So what ends up happening with a 50 delta option is it will have the highest gamma. And then as an option goes further in the money or out of the money, it will have a lower gamma. Gamma represents the rate of change of delta. So here's the scenario. The scenario we were just looking at is, don't worry about the days to expiration. We'll use the 30 days to expiration. Pretend this one doesn't exist. This is comparing expirations as well. So the scenario that we were just looking at is the equivalent is one person's buying here and then one person is buying here. So what's the difference? Well, the difference is as this goes up, the expansion of delta is actually going to slow down because this option is going to go from being at the money of 50 delta and it's going to start being in the money. It's going to be 60 delta, 70 delta, so on. So the rate of change of delta is actually going to go down. Whereas this option, as the underlying starts to go up, this thing is going to gain a bunch of gamma and delta. And this one's cheaper. So we can buy 2, we can buy 3 for the cost of 1. So the reason why we use sometimes further out of the money options is for a concept we call convexity. And this is convexity. It's just kind of flipped from the way that we typically think about it. Lauren says, room to grow and cheaper. Bingo. That's exactly it. So if I put on the same dollar size position between these two, I can put on a bigger position that's further out of the money. And then if I get the move that I want, I can experience much larger return, comparatively speaking. Now, there's always a trade-off. So what's the trade-off here? The trade-off is very simple. If we compare this scenario, and let's say rather than a 15% move, let's say we get a 5% move. A 5% move on the 50 delta option, you make $55. A 5% move with 2 of the 20 delta options, you get 49. You literally make less money on the same move, even though you have 2 options compared to the 1. So what this is showing you is in order for those further out of the money options to pay out, you need a bigger move. You need more convexity. Otherwise, you need a bigger move to tap into the convexity. Otherwise, if you don't get a big enough move, then you simply don't make the money. So 50 delta options will make you money faster in terms of how much move is required. Whereas further out of the money options have the capacity to compound a lot more. Great question. GP says, what's the best tool? If I buy calls slightly in the money and I buy them at 30 days to expiration 90, if price pumps up to 28.30 in the next 2 months, will IV still pump my premium up? It depends on how IV moves. And when it comes to the best tool, it really does depend on like what you're using the tool for. So I genuinely can't intelligently speak to Market Chameleon because I haven't really used it. I can speak to the tools that I use, which again, as you know, one of them is Unusual Whales, and I use it for a bunch of different things. So Market Chameleon, if I'm not mistaken, has a ton of capabilities that Unusual Whales won't have. Unusual Whales is very options focused. So I think it really depends on how you use the tools. I wouldn't view there genuinely as like there being a quote unquote best. I think they're all relative. So if you're applying a certain trading approach, I can absolutely see a world where Market Chameleon might be relatively better. So yeah, a bit different. Colin says, this has been so great. Thank you. That's awesome. I really think this was actually a really, really great session for a bunch of different reasons. There's really important stuff that we talked about here in terms of the nuance of trading options that most people miss. And then they unfortunately have a superficial understanding. And then when things move differently than they expect, then they're kind of sitting there left scratching their head wondering like, what the hell happened? Why didn't this go the way that I thought it was going to go? So yeah, I'm glad that it was useful for you guys. But that wraps me up. We are about to grab some dinner and then we're going to the local fair to go blow a bunch of money and have some fun. So as always, if you guys have any questions, let me know. For the Outlier Pro members, we have a stream set for tomorrow, market prep, to get us ready for the week ahead. Newsletters coming out tomorrow. And then also the weekly video is coming out tomorrow. And then for a preamble on the weekly video, it's going to be 0 DTE options trading strategy for beginners. So be an outlier. I'll see you guys later.